The weighted average cost of capital approach is very common, everybody uses it, but it has some limitations, especially when the capital structure changes or when the cost of capital changes. For example, if you are an entrepreneur and you have a small company which is full equity finance, you have no debt, but you will be acquired by, let's say, I don't know, Walmart or a big company, and the valuation will use, of course, the capital structure of the acquiring company, because they will buy a small company and then they will move to the leverage policy of the acquiring firm. Therefore, in case you forecast a capital structure that changes, or an income tax rate that will change, or costs of capital that will change, the weighted average cost of capital, being an average, will simplify all that information into one number, which is unfair many times. So this other approach, the adjusted present value, is an alternative approach. It's not very well known, but its basis is the same as present value, net present value, and it can be shown that in case the inputs are stable, then the weighted average cost of capital will not have problems in simplifying inputs, and therefore the results will be the same. But in some cases, as I mentioned before, when the capital structure changes or the income tax rate changes, the weighted average cost of capital will simplify important information and will not lead to the same result as the adjusted present value. So in this case, we will cover, this is kind of a long example, but it's very simple. We'll work in steps. The first step is to forecast the income statement, and then the balance sheet. Of course, we need the financial statements to value any company. We need to forecast how much the company will sell, how much the costs we expect will be, etc. And then the third step is the free cash flow calculation. Please notice that for both methodologies, APV and WACC, the first three steps are the same, exactly the same. We need to obtain this number, which is the free cash flow to the firm. From now on, they will separate, and that is why we will start with the WACC approach, and then we will move to the adjusted present value approach. In the WACC approach, the difference basically is that we will use an average rate to discount those free cash flows. Therefore, we have, for example, a capital structure with some debt and some equity, and we have a cost of equity and a cost of debt, and the WACC will average these costs, and that will be the discount rate of the WACC approach. On the adjusted present value approach, we will not calculate any kind of average. We will simply start from the free cash flow to the firm calculation, which I mentioned before is the same for both methodologies, and we will use first the cost of equity capital as the discount rate, which will be terrible because it's a high rate. It's higher than the WACC for a leveraged firm, and therefore the enterprise value will be very small. But we will be assuming for a moment that the company is full equity. So this will be the value of a company as if it were financed only by stockholders without any kind of debt. and this will be a small value, for example, let's say 100, but then we will use an important property of the net present value, which is its additivity. We can add present values very easily. And so we will add the present value of the tax shields, which is, we know by Modigliani and Miller, which is the big difference in value between a firm without debt and a firm with debt. Therefore, we can forecast here the tax shield for the company. We can discount such tax shield to present value using a different discount rate. In this case, we will use the cost of debt. And finally, let's say we obtain that the present value of tax shield is, I don't know, 20. Well, then the company value will be 120. We will add steps A and B to obtain the value of the company. It's a very simple approach, but it may lead to different results than the WACC approach, especially in cases where the WACC simplifies. So I think this is an important methodology to use, especially for startups, where you expect the capital structure to change. Usually in a startup you have no debt at the beginning, then you have a lot of debt because you need seed capital for investments, and then you end up with some kind of stable company with a debt ratio probably more similar to the industry ratio. So in a startup, changes will occur, and this is a very interesting valuation approach to use. Okay, let's start with the income statement, then we will move to the balance sheet. The very first number we need is the NOPAT, net operating profit after tax. We don't know the tax rate. We can calculate the tax rate from the forecast we already made. So let's say for the first year, for next year, we are forecasting earnings before taxes of 11.9, probably millions or thousands, and taxes of 4.1. Therefore, how much is the tax rate? Well, we're paying 4 in taxes on earnings of 11. We are paying the 35%. We copy for all years. We can see here that the tax rate, the forecasted tax rate in this case, goes down. This may occur for many reasons. For example, if you are planning to operate in different countries or to expand to other sectors, this can perfectly occur. Or for changes in the applicable rates and determined by the government. Now we calculate NOPAT, which is the operating profit minus taxes. This is the only number we need from the income statement, the NOPAT, net operating profit after taxes. We did this before. If you would like to see other examples of free cash flow calculations, you can go back to chapters 6, for example, 7, where we calculate free cash flow and EVA. So here NOPAT will be the operating profit times 1 minus the tax rate. We will of course obtain a smaller number, because what we are really doing is we are deducting taxes. So here we have the operating earnings of the company after tax. Now let's move to the balance sheet. There is only one number we need from the balance sheet, and that is the easiest to find: total assets. We need to convert total assets into invested capital. In this case, we will simplify. We know that capital equals to total assets minus the non-operating assets, total capital minus, total assets minus non-operating assets. For example, this could be cash, excess inventory, goodwill, investments in other companies. In this case, we will assume non-operating assets equal to 0, just to simplify. And then we need to deduct non-interest bearing liabilities. This is basically the accounts payable, and we will assume them equal to 0. We will assume that all debts and all liabilities are expensive, which is the most common case. Actually, money is not free, and therefore in this case capital will be the same as net asset value or total assets. This is the simplification we will assume for our example. Okay, so here capital will be increasing from the first year to the second one, and then again increasing from the third to the fourth year, and then decreasing. Therefore, we will have positive and negative investment. In the first case, how much is net investment? Well, we're saying in our forecast that we need 133 million in capital. For example, this could be machinery, equipment, inventory for next year. And now we have only 132, therefore investments will be 863, which is the difference between the capital we need next year minus the capital we have today. We repeat this for every period, and notice that in the last one we end up taking an empty cell. Therefore, we need an assumption. For example, if we assume the capital to remain constant, then net investment will be 0. It means we are basically covering the depreciation of assets. Okay, so we have the balance sheet and the income statement, and now we can calculate free cash flow. We do not need the right side of the balance sheet. Here you can see in the right side we have liabilities and equity, but we will use this on the discount rate. Therefore, we're not using the right side of the balance sheet to calculate free cash flow. We will need them for the capital structure calculation. In this case, you can see in the balance sheet that there are mainly two types of debt. One, which is remaining constant, and another one we plan to cancel. We plan to repay these bonds. Probably they refer to some startup of the company. And so the capital structure will change. We start with a lot of debt at the beginning, with more than half of debt. And then we end up with less than 1/3 of that. Something like this. Therefore, the capital structure is expected to change, and this will make the WACC approach unfair, and making important simplifications. Okay. Let's calculate free cash flow, which is the last step that we can use for both methodologies. We have NOPAT from the income statement. We already calculated the tax rate, so and we calculated NOPAT, so we just find this number, which is in line 22. This is the only number we need from the income statement, and the only number we need from the balance sheet is capital. Again, we already calculated net investment, therefore recall that free cash flow will be NOPAT minus net investment. Net investment, again, is the capital we need next year minus the capital we have today, and we need an extra estimation. Right. NOPAT less net investment, this is free cash flow. Okay, the company is expecting to generate positive free cash flows for all years. We will assume the last year as a perpetuity. And now we separate the two approaches. Let's start with the WACC approach. What we need is to calculate the discount rate. We will use these cash flows we have in line 75, and we will discount them using an average rate. So we need to determine how the company is being financed, how the financing mix is. For example, what is the percentage of debt and equity, and what are the costs of debt and equity, and the tax rate, because we need the cost of debt after tax. But the problem is that they all change. For example, let's start with the amount of debt. We mentioned before that it starts being 61%, and then it goes down to 33%. The same with the amount of debt of equity. It starts being small and then it increases. Therefore, here we have a problem. How do we simplify all these informations, all this data? Okay. Debt to total assets, as we mentioned before, according to our forecasted balance sheet, was 61%, and it was going down to 33%. And we can calculate debt to equity, or if we want, we can calculate equity to total assets. We may estimate different ratios. Debt to equity will be (61) divided by 39. This is debt to equity. Okay, and now how do we simplify these capital structure ratios? For example, can we use an average? Is this fair? No, it's not. But we need to choose only one capital structure. We may use a target capital structure, talk to the managers, and they will tell us. But again, this is a forecasted balance sheet, and so we are forecasting different things in the discount rate and in the free cash flows. And this inconsistency is what is a limitation of the WACC approach. Okay, then let's estimate the cost of equity. For this example, initial cost of equity was 10%, but the problem is that, let's find the unlevered cost of equity here. It's going to be 10%, and the cost of debt will be 4% in this example. But the problem is that if the company changes the capital structure, we know by the Modigliani and Miller formula that the stockholders need to adjust the required rate of return because they have different levels of risk. Leverage means risk for shareholders, and so they cannot require the same return rate in a full equity company than in a leverage company. So we will use the Modigliani and Miller formula, which you can see here, to estimate the levered cost of equity in each situation, which is, we start with the unlevered cost of equity. This is the asset required rate of return. And we add the debt to equity ratio here. We just calculated the debt to equity ratio times the difference between the unlevered cost of equity minus the cost of debt, which is, this difference would be in this case 6%, 10% minus 4%. Okay. We calculate this for each period, changing the debt to equity ratio, and we can see that then the interpretation of this cost of equity is that when the firm is levered, the stockholders will require a higher return rate than when the debt is reduced. Okay, now we need a target. Therefore, we have the same problem we had before. How do we summarize or resume all this information? Well, let's say we want to calculate an average, which is unfair and not necessary. You will see that in the adjusted present value methodology, we do not have any of these problems. And finally, we need to forecast a single income tax rate. Let's find the tax rate we calculated before. Here on line 21. And again, let's calculate, for example, an average or a target of some kind. Okay, and now we can compute the weighted average cost of capital. Just now, let's remind the formula. In this company, the weighted average cost of capital will be the percentage of equity times the cost of equity plus the percentage of debt times the cost of debt after tax. And so the amount of equity in this case will be the difference between 100% minus 46.5. And then the amount of debt will be 46.5. And then, well, the cost of equity here is the one we estimated, 15.7, and the cost of debt is 4% minus the tax rate. Okay, let's start with the amount of equity and the cost of equity. We have here 53.5% of equity, which costs 15.7%. This is the cost of equity times the amount of equity in the capital structure, plus 46.5% of debt times the cost of debt, which is 4%, times 1 minus the tax rate, which is in this case simplified to 29.4%. Okay, 9.7, remember this number please, this is the weighted average cost of capital. So as you can see, the difficulties in this approach are not necessary. We are simplifying important information, and we are doing this only to arrive to a single discount rate. So let's calculate the present value using this 9.7 discount rate. The discount factor will be 1 divided by 1 plus the discount rate, 9.7, to the power of, to the power of 1. Then for the second period, the discount factor will be 1 divided by 1 plus 9.7% to the power of 2, etc. The last discount factor, being a perpetuity, will be 1 divided by the WACC times the previous factor. Okay, the present value of free cash flow will be the free cash flow which we have on line 75 times the discount factor. For example, in this case, we are expecting to generate $6.9 million in free cash flow, but we will only assign a present value of 91% of such number. So we have a present value which is lower than the original value. If you would like to see again the discount factor of a perpetuity, you may see the videos of our previous chapters. The discount factor in this case will be 1 divided by the weighted average cost of capital minus the growth rate, which in this case is 0, that's why I didn't include it, times 1 divided by 1 plus the weighted average cost of capital to the power of the previous discount factor. That's why I directly use 0.69, which is the previous discount factor. Okay. Okay, now what is the value of this enterprise? We add all the present value of free cash flows, and we have here $113 million. Okay, remember this value, we will obtain a different one with adjusted present value. A little bit different. Okay, let's move to the adjusted present value approach. The free cash flow we already estimated here on line 75 is our starting point. We don't need to repeat that. But now there will be no simplifications, no average. We simply take this free cash flow and discount them at the cost of equity. Okay, so we use the free cash flow to the firm, and we use a very high rate, the unlevered cost of equity, which is 10%. The unlevered cost of equity is a high rate. The WACC will always be lower than that for a leveraged company, for a levered company, sorry. And therefore, if we use a high discount rate, the present value will be small. But this is only because we are assuming that this company, for a moment, is full equity finance. Therefore, it has no value of tax shields, and that's why the value is small. It's a part of the value. Is the value the stockholders would have if they had no debt. So let's calculate the discount factor at 10%. This is year 1, 2, 3, and 4, and the discount factor will be 1 divided by 1 plus the unlevered cost of equity to the power of 1. We repeat for all years, and in the last one we do the same, but instead of using WACC, we use the cost of equity as the discount rate. 1 divided by the cost of equity. We assume growth to be 0 times the previous factor. All right, present value will be the multiplication of each free cash flow times the discount factor. And now we can sum up. 109, which is, you can see, is smaller than the enterprise value, of course. It will always be smaller. And now we need to add the present value of tax shields. So how much is the tax shield? Well, if we can deduce the interest on that, paying less taxes because we have to pay interest, and therefore we show a smaller earnings before tax. We need to find on the income statement how much is the interest on debt we are expecting to pay for each year. So let's go to the income statement. And here you can see that on line 16 we have the interest expense we will pay. And we can deduct taxes from this interest. Therefore, if we multiply the interest times the tax rate, which we already have, again we go back to the income statement. Please notice that we are not simplifying. We are not using just one tax rate. We are using the tax rate that is expected for each period. And we are not simplifying the capital structure to only one. We are using the interest that should be paid in each year. You can see the interest is going down. We are repaying debt, and therefore the costs of financing are being smaller. We take the real number we have forecast. No simplifications. Now, this is a discussed issue. There's a debate about which discount rate should we use. The creator of this methodology, Myers, used the cost of debt, which is what we will do. But others, like McKinsey, will use the unlevered cost of equity. Luhrmann from MIT would say, well, the tax shield is a little more risky than debt because sometimes we cannot recover taxes. Therefore, he will use a rate a little bit higher than the cost of debt. Well, the difference is not significant. In this case, we will use the original approach, which is to assume that interest and cash flows from debt have the same risk as debt itself. So the discount factor will be 1 divided by 1 plus the cost of debt, 4%, to the power of 1. We repeat this, calculate the discount factors for all periods. And again, the last one is 1 divided by the discount rate times the previous factor. We calculate the present value. And the total of present values of the tax shields are 10 million in this case. Therefore, the value of the enterprise will be the value of as if the company were financed only with equity plus the present value of the tax shield. We can do this because of this important property of the net present value, which is that it's possible to add present values. It's additivity, which is not shared, for example, by the internal rate of return. There's no additivity in the internal rate of return, for example. Okay, you can see here that the value obtained with the adjusted present value approach is a little bit different. And this occurs only because there are changes in the capital structure, there are changes in the income tax rate that we are simplifying in the WACC approach. Therefore, I would choose adjusted present value for this company, no doubt. If we calculate EVA, the final number will be the same as the WACC approach, because it also simplifies the discount rate into only one discount rate. For example, in this case, the EVA approach would use capital, which we already calculated before from the balance sheet. We have capital on line 42. Return on invested capital, which is NOPAT, divided by the amount of capital. We already have NOPAT here. NOPAT divided by capital. And the WACC, which is 9.7, and therefore EVA will be capital times the return on invested capital minus the weighted average cost of capital for each year. So in this case, it will be for the first year. We have 132 million with a return of 5.9% and a higher cost than that, a cost of 9.7. Therefore, the EVA will be negative. We are destroying value. To create value, we should obtain a return higher than the WACC, than 9.7%. Now let's calculate the discount factor. 1 divided by 1 plus the weighted average cost of capital, that is 9.7%, to the power of 1. And the last factor, 1 divided by the WACC times the previous factor. We calculate the present value of EVA, multiplying each EVA times the discount factor. We can sum up. And we need to add initial capital for the EVA formula. Okay, 113. Remember, this should be exactly the same number we obtained before in the WACC approach. 113, and here 113. This is the enterprise value of the WACC approach and of the EVA approach. And on the adjusted present value approach, we have a little bit higher value, probably because we underestimated the tax shields on the other two approaches. Well, I hope you like the example. Again, the WACC is the most common approach. In my opinion, it's way more complicated. You need to simplify a lot of things. Imagine if you have a company where you have debt in different currencies. For example, you have debt in the US or in Canada with different currencies and different maturities, and you need to simplify all that information. That is very complicated. In this case, you may repeat step 5. You may repeat this as many times as you like. You may calculate the present value of the tax shields on each bond, corporate bond, or on each loan the company has, and you don't need to calculate any type of average. You simply use the capital structure of each year. You simply use the tax rate of each year, and therefore it's going to be a longer spreadsheet, but way more fair than the WACC approach. Okay, I hope you like it. I'll see you soon.